With two-thirds of the S&P having reported, our next guest says the breadth and depth of EPS surprise has been strong and that EPS growth is better than average. So what does it all mean for this year's rally? Well, joining me now is Venu Krishna, head of U.S. equity strategy at Barclays. Venu, it's great to have you on. And let's start right there. What does a stronger than expected earnings season so far indicate for stocks that are trading just a little bit off of record highs?
I think the outlook is good. But in the short term, I would caution that, we could be open for some choppiness. You saw that when the macro data went the other way on NFPs last Friday, how the reaction was pretty sharp and violent. But from an earnings standpoint, the news is very good at an aggregate level. So we are running sales at over 5%, earnings at over roughly 8.5%. It means there's positive operating leverage in the market. But I think if you peel the onion somewhat and look at what's driving the market in the earnings season, there's a clear bifurcation. So big tech has blown through the numbers, posting earnings growth of 27%, a net margin improvement of almost 200 basis points, and an upside surprise of over 12 percentage points, which is pretty stunning, compared to expectations. But it's outside of tech, especially big tech and rest of S&P, where I think there are already signs that there are building margin pressures to varying degrees.
Okay, and when we talk about those building margin pressures, is that things like tariff impact? And if so, is that a buy right now, or do you steer clear and just stay with big tech?
I think, from a sector standpoint, we like big tech. We've liked it for over 2 years now. We're not changing that. We like financials a lot. But outside of that, everywhere else, you want to be careful. And that's consistent with the fact that if you look at, where the consensus earnings estimates are, outside of financials, big tech, and let's say real estate, most of the sectors are faring much worse than their long-term averages. So you do have to be selective, which means there's a lot of idiosyncratic risk, and a lot of it stems from tariffs for sure. And different companies are able to address it to various levels, right? So you need to pay attention to that. Those who are able to pass through the price increases are obviously better cushioned, but where demand is likely to be relatively more inelastic, let's say in consumer exposed spaces, like in staples and discretionary, it's a different story altogether.
So your current base case, 2025 for the S&P, your price target is 60.50. We're way above that, 63.41 right now as I speak. I realize your upside case is 6,600. Is that what you're working off of, or do you think we get a pullback here?
Well, you could get a pullback, but I think the range of 60.50 to 6,600 is reasonable. But to be honest, we're looking past this year, because I think this year has been, completely dominated by policy uncertainty, and we're getting past peak level of tariff uncertainty. We're getting past peak geopolitical risk. And I think if you look into next year, the reason why we're optimistic is in an environment in which economic growth moderates but remains better than this year, where consumption improves compared to this year but remains weaker than the longer-term averages, and where inflation moves in the right direction but remains sticky compared to the Fed's target. In such a world, we still see earnings growth accelerating almost 9%, and that's why it leaves us optimistic to go into next year. So the question is, how do you position in the short term when once you start peering beyond 3 to 6 months, things actually start looking better? So I think we remain optimistic. And so the level, of course, keeps changing from day to day, depending on what the real catalyst is.